The Aussie-US exchange rate is now below 105 and looking a bit weak. It's been affected by yesterday's statement from the president of BHP's iron ore division, Ian Ashby, that China's demand for iron ore is flattening out. And that came on top of the lower GDP target announced by the Chinese government a couple of weeks ago. Now, on the subject of iron ore, this chart demonstrates an issue that's becoming a bit of a worry. Global iron ore production has risen much faster than steel consumption. The reason seems to be a lack of scrap iron in China, in turn caused by the fact that they haven't got many cars yet, and the cars they have got are not very old, not old enough anyway to squash for scrap. That means the feed for Chinese blast furnaces has to be mainly iron ore for the moment, but it shouldn't be long before there's more scrap available in China. Also, the Australian dollar got away from its attachment to commodity prices in January and February, but in March it's been getting reattached. That is, it's been falling while the commodity trend has continued higher, and that's happened because American long-term interest rates are on the rise, sucking money back into America, pushing the US dollar higher. Commodities had a rough session last night with big falls by metals, oil and wheat. On the share market, the All Ordinaries fell 0.4%, and the main influence was BHP, as it was on the dollar, but there was also some ugliness around retailers. Not just David Jones and its expected 40% slide in profit, but also Kathmandu shares slumped 16% after the company said interim profit fell 43%. And Oriton shares fell 3.5%, even though the company defied the retail gloom and managed a 9% lift in profit. The banks all went down. And the fall in Australia was more or less in line with what happened around the world today. And that's finance.